When taking a mortgage, you'll need to take a mortgage product from a lender. There are several types of mortgage products, but I'm going to talk to you about three. We've got a fixed rate mortgage, we've got a variable rate mortgage, and a tracker rate mortgage. A fixed rate mortgage tends to be the most common because what this will do is it will provide you with a fixed rate for a period of time. That could be 2 years, 3 years, 5 years, or even longer, depending on your circumstances. The benefits to fixing your interest rate is essentially knowing exactly what your monthly payments will be month in, month out. Therefore, your product interest rate is fixed and therefore it will not change and it cannot fluctuate. A variable rate mortgage is essentially that. It varies. It can vary from month to month, and that rate is set by the lender. So therefore, your monthly payments can vary month to month and therefore provide you with a little less security, not really knowing what you're paying month in, month out. A tracker rate mortgage is a type of variable rate whereby the lender sets the rate, which is set above the Bank of England base rate. So if the Bank of England decide to change their rates, increase, decrease, what that can do is it can make your interest rate vary month to month, again, giving you a different monthly payment potentially, which can go up or down. When taking a mortgage, whether it's for a purchase or whether it's for a remortgage, what you'll have and what you'll need is a deposit to place down for the purchase, or you'll have a certain amount of equity within your property when you're remortgaging. Both of those, the deposit and equity, essentially make up a percentage of the value of the home. The higher that percentage that either you're putting down as a deposit or that you have as equity can have quite a big impact on the product and the interest rate that you can obtain. So for example, if you've got a larger deposit or a larger amount of equity, that's going to provide you with a lower interest rate option. Whereas a lower deposit or a lower amount of equity, essentially what that will do, that will attract higher interest rates. When recommending a mortgage for a client, it's not about achieving the lowest interest rate on the market. It's about achieving the most cost-effective mortgage for a client. And what I mean by that is a product from a lender can contain several different costs. It can contain a product fee, a valuation fee, and other related costs. So what we do for that product term chosen for a client, whether it's 2 years, 3 years, or 5 years, we total those costs. And that is an overall true cost of the mortgage. And that true cost figure is the one that we use to then compare with all the products on the market to see which mortgage is the most cost effective for you. One of the advantages of using a broker is that we're not tied to one single lender, therefore having a limited range of products. We've got access to thousands of products across the market, which consist of exclusive deals that you wouldn't be able to access directly, therefore saving you some money. So if you're a first-time buyer, a home mover, or an existing mortgage client looking to remortgage onto a better deal, get in touch and we can help you.